please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, well, the first meeting of the FOMC, or the Fed Open Market Committee, ends later today. This is Janet Yellen's last meet as Fed chair before handing over the powers to Jerome Powell. As always, CNBC's Steve Leisman is here with the expectations.
CNBC Fed Survey for January shows that market participants are looking for a bit more from the Federal Reserve this year when it comes to interest rate hikes. 95% of our 40 respondents see no hike coming at the meeting this week, and 90% say the first 25 basis point rate hike will come in March. But they're looking for 3 rate hikes this year, actually 3.21. What does this mean? It means your average person looks for 3, and the second most common answer is actually 4. That's a change from the last survey. Now that we're adding in or starting to think about that 4th rate hike this year. And you can see that in the outlook for rates. The 2018 average, 2.2%, or a full percentage point and then some when it comes to the Fed rate hikes. 2019, 2.8, not much more in 2020, but the long run, 3.2%. That's also higher. So overall, looking for more in the way of interest rates. You can see that also in the 10-year yield, where the current rate is around 2.7, going to 3 at the end of this year and 3.4 at the end of 2019. That's not too bad. If you think about where we were a year ago, that was really the expectation for this year at the beginning of 2017. Higher rates may weigh on the market. 28.54 was close of business yesterday, 29.37, so just really 3 or 4% up from where we are right now by the end of this year, and just 3,005 for the S&P by the end of 2019. But even we get higher rates, we'll also get maybe a little bit more growth. Take a look at the GDP forecast. We've gone up, 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 up in each successive survey, adding about half a point to close this year. The expectation is almost 3%, 2.7% for next year. These are better numbers than we've seen, in part because of the tax cuts. That's really the expectation this year. The tax cuts drive better growth. Steve Leisman, CNBC Business News.